The BRRRR strategy is buy, renovate, rent it out, refinance it, then you repeat it. And that strategy, so that's definitely one of the strategies that we're going to review on Tuesday as we go through the strategies. But that is one where you can leverage a lot. You can be creative on the financing too. You can do hard money and then refinance out of that short term, because hard money is usually less than 12 months. And so you can go in, do the renovation, and then pay off that short-term loan with the long-term bank financing, whether it's a normal traditional bank or a credit union or a local community bank, and they'll refinance you out. And when you do that refinance, usually it may be at 70% now, 75%. But when they do that, you're usually, when you go and do your underwriting, your analysis that we're going to talk about on Thursday night, that you try to be all in with your purchase price and then with your renovations to be at 75% or a little bit less than that. Once you're all in, 75% of the after repair value. So essentially, if the numbers work like that, when you do that refinance, you just pay your closing costs and you get all your money back to pay off that short-term mortgage. And now you have a cash flowing rental property that you have 25% of equity still left in, and it's cash flowing, and you don't have any of your personal money tied up in it long term. And so that's kind of what the BRRRR strategy is, where you buy it, you renovate it, instead of flipping it and selling it, you keep it as a rental property in your portfolio.